It's not uncommon to see $1 million W-2s nowadays because of those stock compensation.
That's really interesting. You can see the trends of what's happening in the workforce in this area. Man, I can only imagine if you are approaching or ever want to get to that level and want to figure out exactly what to do with all those stocks that are making you a seven-figure earner, I guess you better watch this episode. Welcome everyone to Office Hours, a tax podcast by Fujikawa Associates, and we are your hosts. I'm Josh Baldovino, one of Derek's clients, and Derek has been a CPA for 25 years. Derek, how are you doing today?
Good, thanks. How are you?
I'm good. So today is really interesting. We are in the Bay Area, and stock compensation is a huge part of a lot of people who work in tech. It's part of their salary package. Unfortunately for me, it has never been part of my salary package going into higher ed, real estate, and then now having my own ventures. But Derek, you see a lot of people's different tax returns. How important is stock compensation?
It shows up pretty much everywhere. We're in the Silicon Valley here. Not all, but a big number of my clients have stock compensation, either be it options or restricted stock, those types of things. They play a big part in a lot of the tax returns that I do.
What is stock compensation?
So stock compensation is really a retention tool that companies use. They'll give their employees or potential employees different types of stock grants, and they vest over time. So it gives you an incentive to stay. The longer you stay, the more shares you'll get over time. They come in the forms of stock options, restricted stock units, employee stock purchase plans. There are others, but those are probably the most common that I see.
What's the difference between the three?
So stock option is the company will give you the right to buy their shares at a set price. So usually it'll be the price at the time that you start. They'll set that price, or when they grant you the options, that'll be your exercise price. And at certain dates in the future, you'll be able to buy that stock at that price, regardless of what the actual stock price is at the time. If they grant you a share at $10 and half a year later it's worth $20, you have the ability to buy that share for $10. And you can either turn around and sell it for $20 and make a $10 profit, or hold on to it and bank on future gains on those shares. So that's stock options. Restricted stock is the company will just grant you so many shares for staying there so long. So every 3 months or every 6 months, they'll just grant you a block of shares. And whatever the fair market value of it is at that time, they'll either pay it out to you in cash, so you can just cash it out immediately, or they'll give you those shares and you'll have to pay the taxes on it, but they'll give you those shares. An employee stock purchase plan is a plan that they'll set up where you can buy shares at a discount. It can be a pretty powerful tool.
So there's three different options. And being an early career professional myself, the moment you get on board onto a new job, there's almost an endless amount of decisions you have to make, right? From your health insurance to obviously compensation, and all of these, some of these are optional things to bring into as well. And I'm sure also allocating what your retirement plan is. I guess that's even a more so reason, especially as salaries in the Bay Area increase, more of a reason for someone to talk to you even beforehand, just to have someone who's seen a lot of these help you make those decisions.
Definitely. There's a lot of information there and a lot of numbers that can get lost in the shuffle when you're going through all that. A lot of my clients have been with their companies for a little while. I'll see RSU grants in the 50,000 range. And if you've held options for 3-4 years, you could cash out and make a few $100,000.
Even when you talk about the high six-figure earners, like the entry level for software engineers, almost like $200,000.
Yeah. When I see someone with like $100,000 W-2, I'm like, oh, that's it?
I get it. Because I'll even talk to friends that are in tech, and they're like, oh, dude, you're not making over 200? I'm so far from that. What are you talking about? You want this admin job for you? I'll get you 180 base.
Yeah, no kidding. Yeah. Admin assistants get stock options, and once in a while have a $300,000 or $400,000 W-2.
Okay. We're talking about stock compensation. How is that taxed differently than your regular salary, the money that you actually get in?
So your salary is just your regular salary. You get that every 2 weeks, every half month or whatever, and that gets put on your W-2. Stock compensation, a little bit different. So you're getting stock, and so it is income, but you don't know what that amount is until you actually receive the stock, right? Like I mentioned with restricted stock units, they'll give you, say, 10 shares of their company stock, but you don't know what that's going to be valued at until it's actually vested and you receive those shares. So once you receive it, say it's $10 a share and you receive 10 shares, that's $100 of income that you have. At that point, you have a couple of options. That $100 is going to go on your wages no matter what. And you're going to have to pay taxes, your withholdings and Social Security and everything with that. Your options are you can either just sell everything immediately at that $10, just basically cash out the $100. They'll pull out the taxes out of that and you'll receive whatever's left. kind of like your regular paycheck. Your other option is you could sell just enough shares to cover those taxes, and then you can hold on to the remainder of the shares. Maybe sell 4 shares out of those 10, pay all the taxes, and then you take those remaining 6 shares and hold on to those long term, or however long you want to hold on to them and sell them, hopefully banking on future gains in the stock. And the other option is you can put your own money in, pay the taxes, and hold on to all 10 shares. So you're going to get taxed on that full amount, the value of the shares, and then they are going to have to take out taxes out of that. So those are your options to do that.
It's good that there's multiple options to put in place once you get those stocks. And I guess for context for everyone, if you think about what the implications could be, I know that you use $100 as a quick math, right? That makes it easy. Realistically, this is anywhere from thousands to hundreds of thousands.
Oh, yes. Yes.
So a 40% swing of one way is a lot of money.
Yes. Yeah. Using the $100 as just a simple factor. But yeah, they're usually in the thousands of dollars, and yeah, oftentimes in the tens of thousands of dollars. So yes, they get to be very big numbers. But what happens is with a lot of these stock compensations, so primarily with stock options and employee stock purchase plans, there can be transactions involved. You actually sell the stock, and it has to go through a brokerage company. But if you don't think about it, and with the restricted stock units, that you sell the stock and it goes through a brokerage company. But if you're not paying attention or just not thinking about it, not worrying about it, you may not realize that you have a brokerage statement at the end of the year, or a 1099 from, say, E-Trade or Schwab or whoever they clear their stock through, and that'll have some stock sales on it. And with RSUs, if you buy and sell the same day, or same thing with stock options, you basically have no gain, but the IRS is going to see that you had some proceeds. And if you don't report that on your return, they'll just tax you on the gross amount. Say you have $100,000 of stock options that you exercised, or RSUs, and it all went onto your W-2, but you didn't report the sale and the cost on your tax return. Then the IRS is going to see that $100,000 and send you a bill for the taxes on that $100,000. And you could get a $40,000, $50,000 tax bill, which is a relatively easy fix if you bring it to me. It's just you have to amend the return, report that income. But that's definitely a shock when a client gets a big $20,000, $30,000, $40,000 tax bill from the IRS, and something they weren't expecting.
And in that sense, it was just a reporting error that 9 times out of 10 could at least get cleared up pretty quickly.
Yes.
And I guess there's other stories too of people who are just cashing out everything, not realizing that they may have to pay additional taxes, and all of a sudden have now bought their new Tesla Model Y.
Yes. That's the other thing. But the statutory rate for withholding on options and restricted stock and things like that is 22% for federal. If you have a large amount, if you're talking like hundreds of thousands of dollars, even tens of thousands of dollars, and you're already in a relatively high tax bracket, the highest tax bracket is 37. If they take 22%, you're already 15% short on $100,000 of income. 15% short, that's $15,000 of taxes you're going to owe at the end of the year. If you spend all that money, then you're going to have to find other places to get that extra money to pay the taxes.
What options do individuals have when it comes to stock compensation in terms of maximizing a tax position?
And the best thing is to talk to me before you do anything. Sometimes you don't have much of a choice. With RSUs, they're set on a vesting schedule, so you have no control over that. But if you have options, then you can decide when to exercise those options. And that's when you have a lot of flexibility. So we could talk and plan, maximize lower tax brackets, spread things out over numbers of years so that you can minimize your overall tax on those things. Ideally, you want to look at the financial side first. So if the stock is at an all-time high, maybe you just bite the bullet and pay the taxes, but you can get that high valuation. But we have to look at everything as a package.
And some of these vestings, if you're 4 years later, then you've decided to accept this job and you get what you get at the end. And if you're getting more money because of the stocks, that's still a good thing at the end of the day.
Yes. Yeah.
With that extra good thing, there's some extra taxes. How about on the flip side? Let's talk about someone who is looking for a new job or got a new job offer. What benefit could there be for someone to connect with you beforehand as they have that offer package on the table?
I guess the biggest thing would be if you had, say, multiple offers and different stock packages. We could run numbers and compare them and see. Obviously, we'd have to project out the stock price and things like that. But using some assumptions, we can compare the packages and see how the compensation compare to each other. If one may be just way better than the other, but it's hard to tell until you actually look at those stock numbers.
That makes a lot of sense. Again, balancing the inputs. And if we're talking about tens, if not hundreds of thousands of dollars, it definitely makes a smart choice. Just at least get a second opinion on your decisions. I know for sure that most people won't understand the tax code as we're talking about stocks. And obviously, there was the COVID run up, and then now we have an interesting situation. So just as the stock market is down from a tax perspective, what do you suggest individuals can consider?
Stock compensation, there's the three different ones that I talked about. With restricted stock units, there's not much you can do. Like I said, those vest, they pay out whatever the value is at that time. So if the stock market goes down, you're just out of luck at that point and you just get paid whatever the value is. But with stock options, you have the option to exercise. You can hold off now. You have a 10-year window once the options are granted to you. You have a window there to exercise those, assuming that you're still with the company that whole time. So you can decide to wait it out if you want. If you leave the company, most companies will have some sort of kind of window where you can continue to exercise after you leave for a short period of time, like 1 to 3 months. But the problem is, say you signed on at a high point and the market immediately goes down, then your options are worthless. So at that point, you really don't have much or any value on those options because you can go on the market and just buy them at a cheaper price than what your option price is. So those are basically what we call underwater options. They'll just sit and hopefully the market will return and bounce back up above that price. The biggest heartbreaking thing that I saw a number of years ago was called incentive stock options. And those allowed you to exercise early. You could buy those shares, hold on to them, and then presumably sell them a year later at a long-term capital gains rate at a big gain and take advantage of the long-term capital gains rates. So what happened, I guess it's been more than a few years ago, but when the market really went down, saying if you had exercised right before the stock market crash, bought this share for $100 and now it's worth 50, you don't get to take advantage of any long-term capital gains because your stock is now worth less than what you bought. There's no gains there. So you don't have really any benefit. The real benefit that you were trying to get with that is gone now because it's worth so much less. And so you actually had to pay the taxes on that $100 a share value, and now it's only worth 50. And so you're stuck in this, you have to pay this big tax bill, but you don't have all that money that you had when you actually exercised it, or the paper money that you had when you exercised. So that kind of hurt a lot of people at that point. The IRS actually saw that this was a big issue at that point. I can't remember if it was the 03 crash or the 08 crash, but one of those two was when they changed the rules and allowed you to take some credits to offset some of those losses that people took.
Is there anything that you're planning for in terms of what 2022 has in store?
Hopefully a big rebound at the end of the year, but it's not looking so great right now.
Yeah, it is interesting, but that's more reason why if you have 3 months left and you are worried about any of the options that you're considering and taking or what's available to you, enact anything right now to affect this year's tax return, right? Because once you go to file next year, whether it be April, if you do the extension, out of luck at that point.
So yeah, right now is a great time to do some planning for the end of the year, although the market is down. So it's hard to do a whole lot when the market's down. But if you do have options that you need to exercise or are looking to exercise or need to do something right now, we can do it now before the end of the year. Right now is a great time because we have that end of the year cutoff, so we can move things from year to year and play around with it and see what will benefit you the most. And once we pass the end of the year, then we're stuck in the next year. So we can legally play with things this year, do some timing things. It's also a good time if you're looking for a new job. If you get into a new company, if they offer stock options right now, the market's really low. You can lock in those option prices at a really low price. So not saying to quit your job and go look for another job, but if you are in that market, it's a great time to, if they offer options, to kind of lock in that lower option price.
You want to consider all possibilities. That would be good. I guess that would be an option. Anything else in terms of stock compensation that you wanted to touch in today's episode?
Nothing in particular. Just talk to your accountant before you do anything, because I've seen a lot of people lose out on a lot of taxes because they just decided to do something and then realized later that they could have saved some taxes using a different strategy.
Yeah, definitely. It's weird to think about your finances almost like health, but healthy finances are important. So you wouldn't have surgery before you consulted a doctor. And if you're not going to sell, you're going to sell $100,000 in stocks, probably at least get a couple opinions there.
Yes.
But anyways, I hope that you all enjoyed this episode. If you did, please give it a like. And if you have any suggestions for whatever else you'd like us to cover in future episodes, any specific questions, leave them in the comments down below. Or better yet, just book a call with Derek. And there's a link down in the description below as well. But Derek, thanks so much today. I'm excited to chat more with other people about what they're doing with their stocks. And I'll see everyone in the next one.
Great. Thank you.